Good afternoon, everyone, and sincere apologies for the delay. We begin our webinar on the importance of sustainability reporting during the World Investor Week 2023, October 11th. I am Tirthankar Patnaik. I head research at the National Stock Exchange. It gives me immense pleasure to extend a very warm welcome on behalf of NSE to all of you. And this webinar, which has been organized under the aegis of ISCO, SEBI, and IFSCA in the year 2023. This year is being celebrated particularly in India from October 9th to 15th of 2023. The themes that we have this year for the World Investor Week are investor resilience and sustainable finance. Sustainable finance is growing rapidly. According to a Bloomberg study, ESG assets would touch about 50 trillion by 2025, which is just about 2 years away, which will be about a third of the projected global assets under management. ESG has undisputedly become an important factor for investment decision making. Our discussion today is on a fairly important part of ESG, which is sustainability reporting, a critical tool for businesses to demonstrate their commitment to sustainability and transparency in today's era, which is defined by environmental challenges, social responsibilities, and of course, ethical concerns. Sustainability reporting, in that sense, is more than just a corporate obligation. It is a declaration of accountability. It is the way businesses open their books, not only to showcase their financial performance, but also to shine a light on their comprehensive environment, social, and governance efforts, ESG efforts, so to speak. Sustainability reporting, in that sense, provides the transparency regarding their impact on the planet, society, and all their stakeholders, which helps investors make better decisions about their investments, beyond just the financial statements. Moreover, sustainability reporting also provides internal incentives for businesses for improvement. It inspires healthy competition and innovation within industries, pushing companies towards more sustainable and responsible practices. Thus, in turn, accelerates their progress in achieving, what we today look at as sustainability goals. So, sustainability reporting standards such as the Global Reporting Initiative, the Sustainability Accounting Standards Board (SASB) have gained much prominence over the last years. These standards provide a structured framework for organizations to follow, ensuring that their reporting is consistent and comparable. In India, market regulator SEBI has mandated that the business responsibility and sustainability reporting BRSR reports will be mandatory for the top 1,000 listed entities by market cap from the year 2023. It was voluntary for the year 2022. This framework is based on the National Guidelines for Responsible Business Conduct, NGRBC in short, which is brought out by the MCA. The 9 principles of this framework include conducting business with integrity, providing sustainable, safe goods and services, respecting and promoting human rights, and promoting inclusive growth, equitable development, among others. I am very, very pleased, and we are absolutely privileged to have a panel of experts who I'm sure will provide a wide range of perspectives on this topic. We have Sivanath Ramchandran. Siva is the Director of Capital Markets Policy India at the CFA Institute. In his current role, he is responsible for advocating policy positions on issues that impact Indian capital markets, including corporate governance, ESG, financial reporting, to name a few. He was part of a SEBI working group that reviewed the related party transaction regulations. My next panel discussant panel member is Kubra Koldemir. Kubra is a founding partner and business writer at Sustain Finance. She's written numerous sustainability articles published in various global publications like Financial Times, The Banker, and Reuters. She holds an additional position as a sustainability researcher at the Arguden Governance Academy. And last but certainly not the least, we have Mr. Nitin Jain. Mr. Jain is a bureaucrat. He is a member of the 2011 batch of the Indian Revenue Service. He is currently on deputation to the IFSC authority as a Deputy General Manager in the Division of Sustainable Finance and in the Division of Economic Policy and Analysis. It's absolutely a pleasure to have all three of you today. And with that, after the introductions, I may go straight to the questions. I will start with Mr. Jain first. Mr. Jain, you are at the IFSC authority. IFSC has, been a trailblazer for us. Gift City, as we know it, for the many of us, is something that India is looking at to be a beacon of investment in the future. So my first question would be to you, Mr. Jain. What do you think is IFSCA's roadmap for promoting sustainable finance through the GIFT IFSC?
Yeah. Thank you, Mr. Titankar, for inviting me and having me here on the show. So, as you know, GIFT IFSC is the India's maiden international financial center. It has the potential, I believe, to act as a global gateway, catering to both domestic and international green financing requirements. IFSCA has been established under IFSC Act 2019 as a unified regulator for the development and regulation of financial products, financial services, and financial institutions in the IFSCs in India, a first of its kind of endeavor. IFSCA endeavors to develop GIFT IFSC as a global hub for green and sustainable finance, facilitating India and other developing nations, particularly in our region of South Asia, to meet their NDCs and net zero commitments. IFSCA, through its regulations and policies, has made a huge progress on the development of three major sustainable finance products, if I may say so: ESG labeled bonds, sustainable loans, and ESG funds. First, IFSCA has notified the regulatory framework for listing of various ESG debt securities, such as green bonds, social bonds, sustainability bonds, and sustainability linked bonds, which are aligned with international standards. I'm happy to inform that as on date, $10.1 billion of ESG labeled debt securities have been listed on IFSC exchanges. Secondly, in January this year, IFSCA came out with a circular for disclosure by fund management entities on ESG schemes. The objective here is to promote consistency, comparability, and reliability in disclosures concerning ESG schemes in IFSC. Our framework is principle-based and largely aligned with international best practices. Considering the transition needs of India, the framework enables strategies such as transition funds and engagement funds. These measures, I'm happy to inform, have led to the registration of first ESG engagement fund with enhanced disclosures with the highest targeted corpus amongst all registered funds in IFSC. Thirdly, on the banking front, IFSCA has issued a framework to promote sustainable lending by IFSC banking units, the IBUs. The framework mandates IBUs to develop a comprehensive board-approved policy on green, social, sustainable, and sustainability-linked lending, which shall duly factor in the principles laid down in at least one of the prescribed international standards. Such entities are also required to have at least 5% of their gross loans and advances directed towards green, social, sustainable, or sustainability-linked sectors, starting from the current financial year. As of today, all the banking units involved in lending have established their board-approved sustainable lending framework and have started providing green and sustainable loans. As part of our long-term strategy, IFSCA had also constituted an expert committee comprising of global leaders in climate action to provide a roadmap. It provided various recommendations for the development of International Sustainable Finance Hub at IFSC. We are currently implementing some of the recommendations, such as creating a voluntary carbon market at IFSC and creating a framework for transition finance. As part of its strategic collaboration and international connectivity, IFSCA has also joined the International Network of Financial Centers for Sustainability, the FC4S, to work along with other international financial centers for achieving the SDGs and the Paris Agreement commitments. And it has signed MOUs with non-profit institutions and think tanks such as CEEW and CPI India, with the idea to share global best practices and learn from each other's experiences.
Wow, Nitin, I mean, one realized IFSCA is a modern regulator, but the kind of vision that it has, will really take us through the next decade at least. So, I mean, my compliments on being so far ahead in terms of the thought process on sustainability.
Thank you.
After Mr. Jain, we go over to the to Kubra. Oh no, to Siva, if that's all right. Siva from the CFA Institute. Siva, I have this question to you actually. It's a generic question, but the thought process is, it might help us understand. Do you see, BRSR reporting contribute to a company's reputation and brand image, or is it only a tick box affair?
All right. Thanks, Tirthankar. Thank you, NSC, for hosting me today. And, thanks, Nitin. It's been a pleasure hearing you talk about IFSC Authority. No, I think to your question, whether BRSR reporting contributes to a company's reputation or brand image, I think even before BRSR of recent origin, even before BRSR, many companies have taken sustainability reporting seriously. The example that comes to my mind is ITC, which have been reporting on social, and environmental issues for many years. Despite or perhaps because of their main business, which is selling cigarettes, right? So it's not as if like companies do not understand the value of sustainability reporting when it comes to reputation and brand image. The only difference is BRSR has made those reporting sharper because it's a set of indicators and you can't just fool around with what you can report and get away with it, right? The second point is, I think at the end of the day, reporting is communication. Reporting is not the same thing as filing. I think we need to kind of make the distinction, because I think if companies think reporting as filing, as something to kind of publish and hopefully nobody reads it at the end of the day, if that's the approach, then I think it's not going to make a big difference or dent when it comes to the reputation or what they are trying to achieve and how they are communicating to investors. So it all depends on how seriously the company is delving into the data collection, what's the process behind reporting, and so on. Because investors can make out which one is a real report and which one is a tick box affair. I'll just give you a couple of examples. I think this year BRSR reports have come out, and we are looking at some of the data points. So one is reporting on pollution, right? So what is your SOx limit? What is your SOx emissions? What are your NOx emissions? And some of these things. Obviously, companies report numerical values, and some companies have reported things like within permissible limits, right? So if you see something like that, you know that how seriously the company has put in efforts to kind of fill that information, right? And lastly, I think I want to address one pushback, which I hear quite frequently, is companies ask whether investors really read those reports. And to some extent, that's a valid question. I think, but the only thing I'll say from an investor perspective, and CFA Institute advocates on behalf of investors, is that it's not like things will change within one or two reporting cycles, but I think over time, investors will come around to, and reputation builds, right? So I think there are plenty of examples both in India and in Western world. I think Microsoft is an example where their reporting on DEI started seriously a few years back, and investors have recognized it as one of the leaders when it comes to that reporting and so on. So I think I'll just finish with this well-cited quote that sunlight is the best disinfectant, right, when it comes to reporting. But I think the caveat is somebody needs to shine the light on data to disinfect it. So you can't just just reporting is not going to going to lead to improvements. I think one of our focus as an investor-based organization like CFA Institute and even National Stock Exchange, organizations like us, we need to shine the light on the data. We need to talk about and so on. And I think over time, then improvements will follow.
Siva, I couldn't agree more. I absolutely couldn't agree more. I think the point that you made about reporting is not just filing, but when you hear companies saying within permissible limits of their emissions, then it certainly does not reflect well. I hope companies take this a little more seriously going forward. But I like your optimism on that matter. But on the idea being analysis or data alone will not be an answer. Or data has to lead to insights, and that analysis needs to be done. I couldn't absolutely agree more. I will go to my next question in this webinar, ladies and gentlemen, to my friend Kubra, who's at Istanbul at the moment. Kubra, what do you think are the benefits and challenges to sustainability reporting?
Oh, okay, sure. I mean, I'm sure that many of you already know, given that sustainable reporting is something that's being done by the majority of publicly traded companies now, but still, I think there are some things that we can discuss which could help make people understand the concepts better. So first of all, obviously, it enhances transparency. Transparency means trust and accountability. So it's very, very important to build your relationship with everyone, with all your stakeholders based on trust. And then also it can attract socially responsible investors and consumers. I think these days we all know that many investors are integrating positive impact criteria into their into their investment process. So it is no longer something, especially in the EU, it's even regulation. So if you are an investor, you have to actually look into ESG data. And then also, in order to access basically those investors, it is very, very helpful. Then sustainability reporting can also help you identify the risks, address them. Another one is that it encourages stakeholder engagement. So what happens is that when you report, you have to put together so much data. And all that data, you have to actually communicate to your stakeholders to get that data, to put it in. It encourages you to talk to everyone. I think that is actually one of the best things about the reporting, is that it builds more relationships. For example, you give that many trainings to your suppliers, so you actually have to, communicate with them to get that data. I think that stakeholder engagement is one of the biggest strongest kind of benefits of sustainability reporting. Of course, then there are challenges. Everybody has been complaining a lot in the last, I think, 5 years or so. It was really a mess. There was so much different frameworks. GRI was one, SASB was another, TCFD was another, and people didn't know where and how to use the frameworks. And also then locally, you had, for example, in India, you have to come up with a business responsibility report, which then if you are an Indian investor, you understand from that. But if you are a German investor, then you have to get yourself familiar with what that is. So all these different frameworks, local versus global versus within the global, also all the different ones, which ones. And obviously, if you are a company who has resources and also, have hired sustainability people who will actually spend their time on this reporting, then you are fine. But what happens if you are a company, small company, just came and became publicly traded? You are already struggling with your resources, and then you don't know where to get advice and so on. So obviously, it can also create a disadvantage for people who are trying to do the right thing, but who may not have same type of resources. So, and another one is, of course, greenwashing. If you could give me 1 minute, especially some companies engage, I think this is already something also so discussed, in fact, that many people
Kubra,
in the market...
Kubra, if I may interrupt, I wanted to get to greenwashing towards the second half of the webinar.
Sure.
I just wanted to go back to Nitin at this point to ask about, how is, from a new age regulator like IFSC authority, what and how is sustainability reporting undertaken across different verticals? You just don't do stocks alone. You do stocks, bonds, banking, capital markets, etc. So, Mr. Jain, any thought along those lines, please?
Yeah. So as highlighted previously, IFSC is integrating sustainability across all the verticals, such as banking, capital markets, etc., which are there in IFSCA. So the reporting related to sustainability, although mainly used in the context of listed entities, can be categorized into two. One related to financial products, other related to institutions. Let me talk about products first, before moving to entity-related reporting. For ESG labeled bonds, such as green bonds, social bonds, sustainability bonds, and sustainability-linked bonds, IFSCA listing regulations are based on international standards such as ICMA and CBI. While the mandated pre-issuance disclosures, such as process for evaluation and selection of projects, the proposed utilization of the proceeds, and systems for tracking its deployment, will provide the proposed sustainability-related features of this instrument, the post-issuance reporting becomes much more important in terms of actual impact and utilization with respect to sustainability. For example, 3 reports are mandatory: utilization report, allocation report, and impact report for green, social, and sustainability bond and sustainable bonds. For sustainability-linked bonds, reporting on rationale for the issuance, consistency with issuers' overall sustainability strategy, and information on performance of selected KPIs become very important. Similarly, for products such as ESG funds, like green funds, transition funds, and engagement funds, IFSCA has issued a framework for ESG schemes mandating full disclosures regarding investment objective, investment policy, strategy, material risk, benchmark, etc., along with periodic disclosures, including monitoring and performance evaluation. Moving on to the entity-related reporting, it is important to understand, considering the increasing significance of sustainability, all type of entities may have to integrate sustainability within their business strategies and move towards reporting. The first step taken by IFSCA in this regard is the requirement for IFSC banking units to report the sector-wise classification of ESG financing, along with a report on overall sustainable financing on a half-yearly basis. We have also taken steps for sustainability reporting by fund management entities, considering huge growth of funds in IFSC. The fund management regulations mandate fund management entity with assets under management more than $3 billion on the 3 aspects. Firstly, governance. The entity should establish a policy on governance around material sustainability related risks and opportunities. Secondly, risk management. The entity should disclose how it identifies, assesses, and manages material sustainability related risks. And lastly, investment strategy. The entity should establish and disclose the process of factoring sustainability related risks and opportunities into fund managers' investment strategies. This sustainability reporting is mostly aligned to TCFD framework, except for metrics and targets, which have been kept optional. The reason being, the financial institutions get the data from corporates, and reporting of metrics and targets is at an initial phase in India. And going forward, we may also evaluate incorporating these metrics and targets once the sustainability reporting among Indian corporates improve.
I think that's a very, very stable and solid approach to have, which also thinks about the future. I particularly like the way you mentioned how dealing is done differently across IFSC's banking units, fund management units. They are asked to, there are asset under management thresholds. It all seems very well thought out, Mr. Jain. My panel members, if I may request you, before I come to the next question to Siva and Kubra, and then again to Nitin, I have a question from the audience. With your permission, I may just put it up to the panel. So this question is from Karishma, and she says, "Hello, sir. I'm working on my research project related to ESG and cost of equity. I see a positive relationship, cost of equity, and maybe the performance on ESG. It means that ESG disclosures. Wow! It says when ESG disclosures increase, the cost of equity also increases. This is divergent to the observation in developed countries. Theory says that Indian investors are not much aware about ESG and they consider it to be the cost. Theory, I further dived down and found the positive relationship is more significant in the environmental context, where in governance it shows a negative relationship and social score has no impact. I'll be glad if you could throw a light on this positive relationship." So Siva, Kubra, and Nitin, this is very interesting. What she's basically saying is that ESG disclosures is leading to higher costs, higher cost of equity. Actually, this is not good for performance. But then she breaks it down and she says, for environment, it's positive, but for social, it's negative. Sorry, governance, it is negative, and social, there is not really much impact. So this is very interesting. Basically, when your ESG score rises in governance, she sees actually drop in cost of equity. But otherwise, this is something that I think this is a question for the panel to field. Any one of you can, take a stab at it.
Okay.
Siva, if you want to.
Sure. I mean, I'm just reacting to it. So the fact that governance is at least leading to a drop in cost of equity jibes with intuition and everything that we hear from the market participants about, like, what they care about, like, importance of governance and so on. So otherwise, like, if that relationship didn't hold, then I really need to question the data or the approach. But I think more broadly, right? So I guess it's there are many aspects to how these relationships work. One aspect is materiality. So I guess how material is these issues to a particular company that matters. So governance matters for all companies. So environmental, social, they matters to a different degree to different companies. But although on average, I would imagine that companies which manage their ENS well should see a priori see a drop in cost of equity as well, right? The other thing is, I think, how much markets value this. So I think I think you alluded to that too, Tirthankar, that are markets like correctly apportioning the value of how companies are doing these things. So I think there could be a disconnect, right? It depends on this how much the so one is like you get an analogy is this value stocks versus growth stocks, right? A value stock remain value stock for a long time before it gets re-rated by a company, re-rated by investors. So I think within ESG too, right? So if the costs are real and like benefits are not perceived by investors to be real, then there could be explanation there as well, right? So I'll stop there.
I think this kind of segues to your earlier point. Investors at some point will start realizing, and that's when companies will move away from merely filing to actually reporting and showcasing their kind of activity on ESG. And in that sense, I believe that the correlation that Karishma is seeing at the moment on governance will also be echoed on social as well as environmental factors. Yeah. My next question, panel members, is from Himangi Yatin, and it's a simple question rather. She asks, do unlisted companies make ESG disclosures, and if so, in what format? Siva, are you aware?
Not particularly in India, but I think so there is nothing. So the rules for the BRSR originally came from the Ministry of Corporate Affairs and so on, right? SEBI mandated it for top 1,000 companies, so it is not the framework is applicable for companies, right? Not just for listed ones. But I am not aware of how much unlisted companies do. I don't know if there is an international equivalent which
Kubra might throw some light on us. I think what she's asking is not how many unlisted companies do, but if they do. My response there would be that yes, there are unlisted companies which are ahead of the curve, just like your example of ITC, which basically went ahead and reported their activities on environment even before it was mandatory. So I'm sure there are unlisted companies that follow similar guidelines or similar thought processes. Kubra, any thoughts? Do unlisted companies provide sustainability reporting?
I think there are also a lot of studies being done. I would recommend, I mean, like private companies too, right? How they should do sustainable. I think one source to refer to honestly is CAIA, similar to CFA Institute that Siva is representing. There's also CAIA Institute.
Yeah.
They are called association, I think, but they do similar work and they do it for alternative investments. I think. Maybe going on their website and finding, they actually also are seeking about how they can improve, understanding of the regulation for them, for alternative investments and so on. So maybe that's one source.
I think that's a fair reference. That's a fair reference. Nitin, I'm not sure if IFSC authority looks at unlisted or mandates BRSR reporting from unlisted entities, but if it does, it would be nice.
So actually, we are looking at the financial institutions which are here in IFSC. Basically, for if you see the fund management entities, the IFSC banking units, and listing currently, as you know, the listing of equities in IFSC is currently not happening. It is, you may see going forward very soon. But despite that, all these institutions, they are making sustainability reporting to IFSC as per its regulations, as per its governing regulations in that area.
Yes, I think Himangi, that question answered you. Well put, Nitin. Very well put. I will go back to the questions again. So now next to Siva. Siva, how does sustainability help, in your opinion, for transparency and accountability?
Sure. I think if the company does the sustainability assessment seriously, then it can find blind spots which will otherwise remain hidden, right? So which leads to risk assessment and which can and mitigation. Just to give an example, right? So in terms of transparency and how it could help. So let's take scope 3 emissions. Now, scope 3 emissions is like, emissions in the value chain. In an ideal world, the supplier, when he sends an invoice to the company, and they will not only put the cost, but will also under the line, they'll say how much emissions, it took to provide that product or a service, right? So in an ideal world, it could happen, and you can tally all your value chain emissions perfectly because the suppliers are giving you the information, and you can report it like this thing. But in reality, it's not there, right? So which means that you should be able to drill down into your supply chain and figure out what your suppliers are doing in their operations, where the emissions are coming from, what are the risks, if there are opportunities for improving the supply chains, and so on and so forth, right? The alternative to transparency is especially in the context of scope 3 emissions, is estimation, right? Now, I remember in one of my previous jobs, one of the interview questions was, can you estimate the number of marriage halls in Mumbai, right? And, I don't remember what I said. Now, obviously, I got the job. All right. My hope is that companies don't do that kind of estimation exercise for their scope 3 emissions, right? They actually go and ask good questions to collect good data, even if they have to estimate, it is estimated based on real information, right? So that's where the transparency aspect comes into, because to report on certain things, you really need to understand your business pollution levels, right? So to give you an example, you can say that it's whatever within permissible limits, but if you really need to know, you really need to drill down, and you will learn something about your business, which is more than what costs and profits, right? So it's a way for companies to really understand each other if they take that exercise seriously. And to the second point, right, transparency and accountability are two sides of the same coin. If you are reporting on something, you need to be able to stand behind those numbers and say that, yes, we have comfort with this and so on. And boards especially, they have responsibility on all reporting, including sustainability reporting. And it is an opportunity for them, to understand more into the business that they are potentially overseeing, right? So I think, to some extent, sustainability can help you understand your business much better than what you would do otherwise.
I think while everything is right, I also notice a sort of lack of required capacity in the entire system here in India. While companies will be expected to provide an better assessment of their scope 3 emissions than estimating number of marriage halls in Mumbai, they are expected to take it more seriously. But I worry about the lack of capacity. The there are not many scholars, there are not many people who understand this in a proper manner, and I believe there is scope for helping companies traverse that roadmap, that route. Actually, there is an enormous amount of scope. The scope 1, scope 2 is fine, but scope 3 will require things beyond what could be done in a on the back of an envelope or so forth. My next question is for Kubra, but before that, I have a follow-up question from Ms. Karishma. She asks, this analysis for across sectors. Now, I know, Ms. Karishma, we can take one more question from you, but let me now move ahead. I would advise Ms. Karishma to write to us, and maybe we'll forward your question because it's slightly more detailed. She's asking, sector-wise analysis on ESG and how her work is done, and rather than analyze that, Ms. Karishma, I will request you to write to us, and I will be sure to passing it on to all three of my panel members. So I go to the next question here. This one is from Ajit Pandey. He says that the task is at hand to explore ways and to effectively communicate the importance of a certain matter and persuade others to take action, despite the potential liability that may create. I think it's a comment. He says, until that matter becomes mandatory, it's important to find the best approach to inform and convince the relevant parties while also mitigating the risks associated with it. Okay, all right. Thank you for your comment, Mr. Pandey. There is another question from Himanshu Bhatnagar. His question is, can we look at different formats for different sectors of ESG reporting? Sectors like banks and FI may not have much to report in scope 1 as versus a manufacturing company. Kubra, Siva, Nitin, anybody?
So I'll briefly say what my thoughts, and others can chime in as well. So I guess it's a fair point that there should be some degree of sector related formats, because obviously not every company in every industry will have the same issues, and I think many of the standard formats, starting with SASB and now is part of ISSB, is based on sector-based materiality and sector-based issues. I guess the only point is the way it has evolved. So BRR been there for about 10 years, and then it evolved to BRSR, which is already a huge leap in terms of number of indicators, number of topics, and so on. And I think that it covers quite a bit of indicators across ES and G, and now as a follow-up, we are trying to rationalize the number of indicators and call it core BRSR and so on, right? So I guess it's just a question of timing. I just want to make sure that we're not inundating the market with newer and newer formats, but we allow the information to come in, from the companies. We allow to digest it, let the market adjust to the new information, investors adjust to the new information. I think before we get into the next wave of improvements that we are seeing. And to a particular question about bank and scope 1 emissions, yes, bank and scope 1 emissions probably not, but clearly banks have a lot of embedded emissions in their loan portfolio and so on. So I think emissions, I can see it as applicable across industries, including banks. Right? So
including banks, absolutely. I mean, they do lend to signal large products. Kubra, yes, your points, please.
Yeah, I think I totally agree with Siva. It's exactly, I mean, think about a bank. I mean, if they have a nice large building, let's say in downtown, sure, they have some electricity and so on, or other emissions that they have to report. But other than that, it's really their loan portfolio. So whom are they lending? That is hugely key, which I also want to come back to later in the third question, when we talk about greenwashing.
Certainly, Kubra. But while I have you here, I mean, may I just ask, what do you think are some of the latest trends in sustainability reporting?
Yes, I also wanted to actually add some more points to Siva there as well. Certainly the supply chain measure transparency and measurement, that's a huge point. It's definitely one big trend. Are we really following the supply chain? And also to the a point that was just made by one of our listeners, it's actually, for example, another one, food sector, right? The food sector, where the farming comes, really, that is where most of the emissions happen on farmland. So not in the supermarkets, and transportation is one important point, but where really the farm happens, where it's produced, that is where actually, in fact, 30% of the world's emissions, for example, happen to come from food sector. And it comes from the supply chains in the food sector. So very well points already made by Siva, that supply chain transparency is becoming more and more popular. People are paying attention to it, to my knowledge, and I'm not sure exactly what the current standing is, but I know that the European Union is looking into ways of possibly at some point coming up with a regulation to actually regulate the supply chain reporting as well. So that's one of the points, and a few others. I think Tirthankar, one of the most popular ones was has been in the last years listening on to TCFT recommendations. They gained a lot of significant traction. Why? Because relatively it is easier and more straightforward to report on climate, especially climate-related goals, carbon footprint, scenario analysis, and so on. Those are like more maths, and you can handle it more easily, for example, compared to social issues. So I think TCFT recommendations have been one of the popular areas. Another one I would say in sustainability reporting, its big trend is having regular materiality assessments. Almost every company, as you know, we had done a research where we analyzed across 7 countries, including India, publicly traded companies and their reports with Dr. Argudan at the Academy. And for example, almost every company that I had analyzed had done a materiality analysis. Why is materiality analysis very important? Is because it focuses on, first of all, reporting also the significant issues for the company, because we know that every company cannot have a positive impact on every issue, because every company is focused on something else, but whatever their core business is something where they can have a positive impact. So it would be very unrealistic for every company, for example, to fulfill all the 12 sustainable development goals, but maybe 3 of them, if we do materiality analysis, will be very relevant, and we can focus on them, and that company can actually create a change in the society for that. So materiality analysis is another one. Another one, of course, human capital management, social issues also are becoming popular, but one of the better ones, are, for example, come in Germany, where you have regulatory mandates on minimum female representation of boards. Or another one, some British companies, for example, I came across and of course across the globe, very responsible companies are not only doing their gender presentation of workforce, but they may also do a gender pay gap. So they report on the gender pay gap to find out what their current situation is, so they can improve. So there are some advanced ways, and they are becoming of reporting on social issues, and they are becoming more popular. Another one maybe that we can mention is biodiversity reporting. I think in the past, companies just didn't really, they only reported on, how they reduce emissions, how they are doing a great job, and, what they have achieved, and how financially feasible they are, but they were not talking about how much while they were doing it, they were also disturbing nature or causing habitat, deforestation, and negative impact on ecosystems and so on. So I think that is also being done. For example, that made a framework like TNFD emerge, which focuses on nature-related metrics reporting.
I think that's you made it very comprehensive, Kubra. Absolutely. I think it sums up the entire gamut of the new and the here and now in sustainability reporting. Thank you. Thanks a lot for that. Ladies and gentlemen, before I go into the final round, I have one question for each of my panel members in the final round here. But before that, I would answer one question that has been raised in here. It's by Mr. A. Ghosh from Kolkata. His question is NSE collating the numerical data from BRSR, which can be accessed by academicians for large sample studies? I'm happy to reply to you in the affirmative, Mr. Ghosh. Yes, it is done. The data for FY22 is already available. The data for some companies for FY23 is also available on the NSE website. I invite you to have a look. And there is a request from Dr. Inamdar from NISM. This is for Siva. He says, thanks for the insightful session. I would like to request Mr. Sivnath to highlight his recent research on the BRSR study and who are the important consumers of the sustainability reporting. Siva?
So our recent published study was on gender. So we published Mind the Gender Gap report in this March, and that was based on voluntary disclosures of about 140 companies. We didn't take all 170, but because of timing, we took 140 companies, and we looked at participation, pay, and some of the other indicators related to gender, and we published it. Like currently we are working on follow up. It's kind of in progress. So I think the idea which I wanted to highlight at the beginning, right? So I mean, sunlight, you need to shine the light. It's not just the reporting or a disclosure itself is going to lead to improvement. You need people to kind of take a look at it. I think the academic studies, once the data is widely available for academic studies, and hopefully there'll be 1,000 flowers which bloom, and hopefully that will lead to some serious questions asked of disclosure quality, as well as the actual data and averages and gaps and all that stuff, and hopefully that will lead to behavioral change, right? So I think that's been our focus at the institute. We are trying to kind of make sure that to our extent our capacity allows, we take a look at some of these data points, and we ask the right questions, and we make suggestions, whether it's industry, whether it's the regulator, as the case might be.
Thank you, Siva. I have to go to the last round now. I'll head back to Nitin. There are a few questions again on our questioning board here, my panel members, but I will come to them after I have this last round. So, Mr. Jain, over to you. My last question in this round is, my first question in this last round rather is, what's IFSCA's or IFSCA's thought process on the evolving landscape of sustainability reporting?
Yeah, so our listing regulations mandate sustainability reporting for IFSC listed companies which have a market cap of more than $50 million. The listing framework accepts various reporting frameworks such as GRI, SASB, TCFD, etc. I have to highlight that IFSC is an international jurisdiction catering to the needs of both Indian and international entities. The sustainability reporting requirements need to be aligned with this objective. Globally, over the years, corporations across the world have converged to a few international frameworks for sustainability reporting. To cater to entities across jurisdictions, IFSC has adopted a flexible approach by recognizing certain prominent international standards, such as the ones mentioned earlier. Let's look at the recent developments. As has been highlighted, BRSR has been mandated by SEBI for top 1,000 listed companies. The Indian listed companies are required to disclose sustainability reports.
Yeah.
In July this year, IOSCO endorsed ISSB's sustainability disclosure standards, IFRS S1 and IFRS S2. ISSB standards have been developed to serve as a global framework for sustainability reporting. IOSCO has now called on its member jurisdictions to consider ways in which they might adopt, apply, or otherwise be informed by the ISSB standards within the context of their jurisdictional arrangements in a way that promotes consistent and comparable climate-related and other sustainability-related disclosures for investors. Considering these developments, IFSCA is currently in the process of constituting a working group to consider and evaluate ISSB disclosure standards in the context of IFSC. considering that IFSCA is a unified regulator, the lens of sustainability reporting is not limited to listed companies, but will cut across other financial entities, like I said earlier, such as banking units, fund management entities, and other major financial institutions in IFSC. Therefore, adoption of sustainability reporting standards in IFSC will be further developed after taking into account all types of financial services and financial institutions in IFSC. I would like to close with my thoughts that, as highlighted earlier, there is an urgent need of capacity building. So I'm happy to basically share that IFSCA is cognizant of this. In fact, it was a recommendation of our expert committee, and IFSCA is also taking steps in this direction so that we build capacity of regulated entities in IFSC in the beginning and then to the Indian entities.
This is very helpful. This is absolutely helpful. I mean, the kind of thought process that has gone into the preparation of roadmap and how IFSC treats both listed and unlisted entities, how IFSC treats entities across different asset classes, different functions in terms of their sustainability reporting is something worth complimenting. Thank you, Mr. Jain. My second question in this last round, Siva, is for you, and so here's how it goes. I mean, see, SEBI is yet to come out with the guidelines on third-party assurance providers. It seems to be the logical next step after BRSR. One is obviously, as you mentioned earlier, about how the landscape of BRR per se. We began in 2012 with 50 companies, then we extended it to 100 companies and so forth. Eventually, BRR was needed for 1,000 companies. BRSR has had a similar journey, while the number of companies has not changed. But what has changed is from a comply or explain, it became a mandatory sort of feature for the top 1,000 companies. One would expect the way forward would be to expand it to a wider horizon there. But if the next thought in terms of sustainability reporting is how worthy are these numbers? They are not just filed numbers, but also reported numbers. And if investors do take interest in them, then the guidelines on third-party assurances become very important. What's the way ahead on this?
Yeah, I mean, it's an important issue, isn't it? I think so. The issue is financial assurance. I think there is a huge industry, and the audit firms have a long history, and they understand the procedures, and they know how to test it, how to provide that assurance, and so on. Non-financial, especially sustainability assurance, is a whole different ball game, right? So it's not. I mean, you can probably port some of the procedures, but obviously the data points, the topics, the themes are entirely new. I think to Nitin's point about capacity building, right? So are these providers equipped to kind of understand the data that goes into it, the assumptions that go into the calculations, and so on, and to be able to say with this thing that the company has followed reasonable procedures to come up with these numbers, right? So there is a even at the content level, there is a it's still a very early stage, and there is a lack of clarity as to how this will evolve. Now clearly. So I think international standards are also evolving when it comes to assurance and so on, right? So I think accounting bodies, they are trying to come up with standards for assurance and whatnot. So there is there is movement there, and potentially SEBI can come up with guidelines and so on for ESG assurance. But I guess ultimately it also boils down to investor trust. So I think even today, when investors look at companies' audited financial data, I think they tend to kind of give weight based on what they perceive as the company's governance, or they tend to discount if they think there are issues and so on, right? So I think we have seen especially in the unicorns and so on, we have seen instances where investors have serious concerns about how much to rely on so-called audited data and so on, right? So even before the auditors themselves had expressed their concern. So I think this will be even more prevalent in case of EST assurance, because EST assurance is inherently new, and it's potentially a lot more estimation which is involved. So I think the level of trust that investors will place will be even more critical as to how much they this thing and so on. So I think EST assurance is the starting point, but I think the journey is much harder, and it's going to be much longer as to how much investors rely on those numbers. That's ultimately goes back to the company's governance. And the last point I'll say is, at the end of the day, EST assurance is not the same thing as accuracy or even materiality. So I think, just because somebody said that these numbers are verified based on their procedure, their tests, doesn't mean that the investors should say that, okay, this is gospel, and they start relying on it. At the end of the day, other things like whether these are accurate, whether whether these are material for the companies in terms of their financial analysis, those things also matter. So it's not like this is not a certificate, right? Yeah. So it's just audit.
Absolutely, it's not. No, it's not. But given where we are today, Siva, I think this will be a first step, I suppose.
Yep, I guess, yeah.
Kubra, your thoughts on greenwashing now, please.
Yes, sure. So I think, again, Siva has already kind of pointed to say greenwashing is problematic for several reasons. Obviously, it first of all misleads the consumers who are trying to make purchasing decisions based on actually some false information. It undermines also legitimate efforts from other companies, because there are environmentally responsible businesses, and they are, when they are trying to do the right thing, overall, greenwashing may erode trust regarding environmental claims. So nobody starts, which is really a big trend, has been a big trend recently. So because it erodes trust, now nobody claims that anyone's environmental claims. So it really can undermine majorly legitimate efforts of companies who are actually trying to do the right thing. I mean, how does it show up? For example, companies may use images or logos or symbols that create a false impression of environmental responsibility. Just, for example, images of pristine natural environments when promoting products, but actually that product is contributing majorly to environmental degradation. So also another one, when companies use phrases like green, eco-friendly, sustainable, are there really clear definitions? Is there any evidence? Is it substantiated? So these are issues. What can investors do, and even consumers do? But from our perspective, what can investors do? They should definitely look for third-party certifications. They should seek transparency, seek evidence to support environmental claims, and remain critical whenever they see a messaging, sustainability messaging that is way too vague. And regulators actually here have a big role to play. I think as long as until they really step in and really create this regulation, things may just go on like that. So also advocacy groups have another area where people can really have an impact, and penalizing organizations, of course, like SEC, for example, has been recently quite active in actually giving real fines to companies that have been promoting false claims. So maybe that is, given that we have someone from a regulatory agency here, maybe that's a small message that I could also give to my fellow panelists.
No. Absolutely. I mean, we are at 5:10 here, local time. I'm sure it is late for Siva, and also, I mean, Kubra will have other work to do as well. But if I may I ask two more questions to the panel? Is that okay? With your permission. So thank you, Siva, Nitin, and Kubra. So one question is on BRSR core. Frankly, it's a way of our current reporting framework, and this question is from Danish Reza from Chennai. It is a very similar question from Megha Basi from Mumbai, and also from Basali Sunasara. They basically want to understand how will BRSR core help and what does it do? So I know, Siva, all of us know about Section 1, Section 2, Section 3. We know about NGRBCs, but anything more, if you could, help with these questions, that will be useful.
Okay, so I think BRSR core at the end of the day, it's about rationalizing the the BRSR itself, right? So one part is clearly the number of indicators in the original BRSR, and if you put it down to indicators, these are the data points you need to collect, and this thing it runs into hundreds for every company and so on. I remember there was I was speaking to a chief sustainability officer sometime, and I asked him about BRSR, and he said if you are asking information on 8 or 10 in indicators or topics, then he will be the one who will be focusing on that data. But if you're asking me to report on 100 data points, I'll ask somebody in my team who's junior who just collect the data and give it away, right? So I think it's just management attention can only be focused on so many things. So I think BRSR core to some extent rationalizes what is important and potentially prioritizes and helps company like that. Obviously, the BRSR core also needs to be assured, so that provides a degree of reliability. But I stand by my previous point that just because BRSR core is assured doesn't mean that it's like you just take it as a given. You still need to apply your own mind as to how you want to use it and so on. So I think it's a step forward. So we just need to see how these data points come through in terms of implementation and how the assurance is being done and so on. So to your question about assurance, I think those things will come into picture as well.
I agree. I mean, assurance is not accuracy. Absolutely not. Absolutely not. My last question now, before I summarize, it's from Ms. Shalini Srivastav from Mumbai. I think her comment is ESG disclosures for the value chain need to be made by the listed company. More guidance is required by way of disclosure, which actually needs to be sector specific. Your value chain actually, absolutely, and I agree with the question here that the value chains, they do differ substantially across sectors, don't they? And particularly for financial institutions, since we, as part of our discussions, agreed that if you look at the institutions themselves, for scope 1 and scope 2, you will probably get all benign numbers. But if you look at scope 3, things become very difficult. And I think her point is well taken that ESG disclosures for the value chain needs to be made a requirement. Perhaps that is something we need to have as a next step, actually. So if there are any final comments from any of the panel members, Nitin, Kubra, Siva, anybody?
Yeah, so I would just like to say that so what we are trying to do here in IFSC is to create an entire ecosystem of players in this space. As our expert committee suggested, a short-term, medium-term, and a long-term plan. And therefore, like to answer what Kubra was saying about the regulator. One thing that came to my mind immediately is that, in our regulations, we have to ensure that the practices of greenwashing, are how we are able to counter that basically. So just a small, very simple thing, like the very first regulation in our ESG schemes is in our circular is on the name itself. Like somebody who is having a majority of the funds deployed in financing and the financing of green projects only can have those kind of names, like Kubra was mentioning, sustainable, green, even in the name of the fund itself. So going forward, IFSC is looking, it is a nascent regulator. So now we are targeting to build an entire ecosystem of players. Slowly, we will be bringing out other regulations for intermediaries, rating providers, the entire, so that entire, we have the entire capability for, mitigate these kind of challenges that we are seeing in this space. And further in the long term, the supervision and the enforcement to further take penal action, as Kubra was mentioning. So that kind of thought process is there in IFSC. We have a short-term, medium-term, and long-term plan to develop and regulate the GIFT IFSC jurisdiction.
Excellent. Thank you so much for responding. That's interesting.
Thank you.
IFSC authority may be nascent, but they are on the ball. They are absolutely quick to respond. Thank you, Mr. Jain, on that.
I just had one comment on greenwashing, right? So, I mean, thinking about it, so there is a saying which is like, imitation is a compliment, vice pays to virtue, right? So I mean, I think you can paraphrase it for greenwashing. Greenwashing is also a compliment, vice pays to virtue. I mean, I think companies which greenwash, like, obviously care about green sustainability enough to kind of at least project an air of sustainability. And what I think is that companies, like, when you start off something like the BRSR, right? So I think, like, the initial reaction is, okay, fine, regulators asking for it, like, just fill something and, like, get it out and so on. Or when investor demands something, green target, like, what is your net zero target? What's your net zero? Like, companies will say something, right? So maybe every real commitment starts with a degree of fakery, and my hope is that companies which greenwash at least are on a path towards real commitment or real reporting. So that's more hopeful way of thinking about greenwashing. I mean, it's a problem, but I also think that maybe there's a feature of sustainability reporting.
You did mention light and the shining of light, Siva. I think at the end of our program, you've also shown that there is a light at the end of this particular tunnel as well. I mean, it just matters how we see it. I mean, I think that's as good a perspective on it as any. So, ladies and gentlemen, that kind of brings us to the end of our webinar today. In this week of the World Investor Week on sustainability reporting, I had an excellent conversation with my three fellow panel members, Kubra Koldemir from Istanbul, Siva from the CFA Institute here in Mumbai, and Nitin Jain from the GIFT City IFSC Authority here. I have one last question actually here from Soham Mishra, as I read from Bengaluru. If, with the permission of the panelists, may I forward that question as well, please? So that question is, in the realm of sustainability reporting, numerous tools exist for calculating GHG emissions. However, some of these tools employ varying emission factors. Therefore, it's crucial to identify a standardized tool that can serve as a common reference. Currently, is SEBI in the process of developing such a standardized GHG emission calculation tool? That's a tall order. I'm not sure if. Yeah, go ahead, please.
I mean, there is a GHG protocol. I would imagine that there are ways to measure these things which are standard. I don't know if Kibra has something.
Kubra, what do you see? I mean, internationally, is there evidence of standardization of understanding emissions?
I mean, I think IFRS is, working right now on some global standards for everything, right? So that's the latest that I know, which everybody knows. And maybe one of the sub details of that, if our listener could look it up and see where that stands, probably I'm assuming that would be maybe one place to search for the answer.
I'm sure. So if I kind of look at the highlights, I was taking notes when you guys were saying. I would say that it's absolutely heartening to see IFSC Authority being a new regulator take such a strong leap and having a well thought out process, a roadmap for looking at sustainability reporting. And it doesn't matter if you belong to any segment of the financial ecosystem. You may be a fund manager, you may be a bank, you may be a listed company, you may have several roles within the financial ecosystem, and the thought process is that IFSCA has understood how you should be going about sustainability reporting. Many of the activities that they've done are in line with the TCFD approaches, as Nitin very rightly pointed out. I think that was also very, very interesting to sort of and heartening to know. And from Kubra, we understood the latest in sustainability reporting that was quite a tour de force, if I may say so. It basically told us how companies are going, deep and into sustainability reporting. And Kubra also told us how, what are the perils of greenwashing. Before, Siva gave us some light at the end of the tunnel, as I said, that it is a kind of, imitation is also a kind of a kind of, what did you say, Siva? Flattery, or it's a kind of
it's a compliment, imitation.
Compliment. Yes. It is. And Siva, your points on assurances per se are not enough. I mean, they have to be accurate. Right now, we don't have third-party assurances, but even when they come, you need to be looking at accuracy there. It's not enough that assurances are bound. And then you also mentioned something very interesting. Companies need to take these reportings seriously. Reporting is not filing, and there is a sort of a feedback loop here. Investors take reports more seriously. Companies take reportings more seriously, and then you get better and better products. And at some point, you get a better and better framework as well, because all the gaps then start coming up to fore. That what exactly is a particular company reporting, and if the standard itself needs to be improved. For instance, are we enough with scope 1, or do we really need to look at scope 2, scope 3? I think in our discussions it became rather clear that when you are looking at financial institutions, scope 1 or scope 2 alone will not be enough. I mean, we have to widen the mandate quite a bit. So there are several important takeaways from this panel discussion. I thank you all, ladies and gentlemen, for coming up to us, and my apologies for starting a little late and also ending a little late, but I believe we all had a period where we learned a little more on this very important topic. My thanks to Siva, Kubra, and Nitin again. Thank you.
Thank you. Thank you, everyone.
Thank you.
Thank you, everybody. Have a nice day. Thank you.
Have a nice day. Thank you.